Welcome to the All Financial Hour podcast with Steve All.
We were talking about some of the market volatility we've been seeing as of late. Well, gold has made lots of headlines out there. It actually reached an all-time record of $5,000 an ounce. And now investors are wondering if they should have it in their portfolio to hedge against inflation and market uncertainty. Here's investment researcher Chris Versace on Yahoo Finance.
It has been a rocket ship ride for gold. And I think what we've seen over the last year is, no surprise, a lot of volatility in the market, a lot of uncertainty. And I do think that we're going to continue to see that. But again, buying gold here, thinking you're going to see another 10%, 20%, it's possible, but it's also possible that, if we see things start to settle down, we could see gold retreat a little bit.
All right. So rather than mess with the strict rules and limitation and fees of owning, this precious metal here, Steve, there's also something called a gold IRA. Break it down for me. What is this? What are the pros and cons when it comes to putting this in your retirement plan?
Well, a gold IRA is where you actually would own the physical gold, bars of gold, not just the right to have it. An ETF, somebody else owns it, and it comes in from there. And you can do it in your tax advantage accounts. If it's in a traditional IRA, growth would be tax deferred. When you take the money out, it would all be taxable. Same thing at the Roth. All growth would be tax free for the future. But it looks like it's more of a diversification tool. As I look at it with a lot of people, when everybody's talking about something, gold, 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 most of the money could have already been made in it because you have to be careful. If you watch gold over time, it's a commodity. And I like to tell people, you can always tell a commodity because if you drop it, when it hits your foot, it's going to hurt. Gold, silver, oil, other precious metals, when it drops. And I look at those things, they usually slowly rise. And then when the, quote, fear factor goes away, they drop fairly hard. We saw some volatility in both gold and silver this week. So I'm going to say be careful on that. Be careful in getting too heavy on it. And the other one that I like to put is I've heard the things where, hey, you can buy gold in your IRA and store it in the safe at your house. I'm going to tell you, you can't do that. If you actually have the availability to sell that bar of gold, it can't be in an IRA account. So be real careful on that when you start to look at some of the things that people are talking about out there. If it's in a custodian, that's what they do. They hold gold bars. That's safe and that's okay. But you buying it and putting it in your safe is not going to work. So be real careful around that. But when you have something that's all they do, the cost could be higher. So weigh your cost versus the benefits as they come from that. And remember, trickles up, drops fairly quickly. So if you've got that idea, gold, should it be a part of your portfolio? How much risk are you currently taking? What would be the reward of it being added? How much it should be? Call us. Let us do that risk-reward analysis so we can look and see where you're at on that scale. And then it might be okay to bring some of that into your portfolio. But it's funny when you actually do some analysis, some people have it in their portfolios. They just don't know it. Give us a call. Ask for that risk-reward analysis. And if you want more information on gold as an investment, give us a call.
Again, for this risk-reward analysis, as you just talked about there, some people are invested in certain things. They don't even have any idea that they are. This is a great idea to, dive deep into that. Risk-reward analysis is going to be complimentary. That phone number, 636-230-8824, 636-230-8824. That website, yourmoneymattersstl.com. Spring cleaning is just around the corner, and I tell you what, I love the feeling of cleaning out a room or a closet and finally donating everything to a thrift store. But believe it or not, there's actually some items they won't take. So, Steve, you can't pack up your used makeup and skincare. They're not going to take that, okay? Sorry to burst your bubble. Old car seats and strollers that aren't up to code. Don't even try it. This is one I didn't know. Kitchen knives of any kind. That's a hard pass. They will not take it. And reusable cloth grocery bags. I have about 30 in the back of my car. Apparently, those are just clutter. They will not let you drop those off.
That's why you have 30 in the back of your car.
That's why. Here I am trying to save the earth, and they won't even take them, Retirement plans also have that, sorry, we can't accept that, motto there. So what are some of those unsafe or outdated assumptions about a retirement plan that you see people hanging on to?
Well, I look at some of those conventional financial wisdom. You're going to be in a lower tax bracket in retirement. I love doing the presentations, and I ask how many people are retired, how many are in a lower tax bracket. Not very many hands come up. I think the thing that hurts us the most is emotional investing. We get that emotions around, oh no, the sky's falling again, or everything's wonderful, I'm going to buy a whole lot right now. I don't have to take as much risk to get the return that I'm looking for. To get a bigger return, I have to take a lot of risk. And I'm not going to need as much money as I do in retirement. And I'm sitting here saying all those things are kind of misunderstandings. And I think that's where we help as advisor. If you're looking for protection, I love the quote, "It wasn't raining when Noah built the ark." Is your retirement portfolio designed so that no matter what happens in the market, that your probability of success stays up? Call now. Ask about our comprehensive retirement plan. Let us analyze your current situation and hopefully assist you in that retirement journey. Because remember, retirement is a journey, not a destination.
Again, for this comprehensive retirement plan, give a call today. Again, it's going to be customized using your individual numbers, your specific situations. Again, that phone number 636-230-8824, 636-230-8824. The website, yourmoneymattersstl.com. It's a question I think is on top of everyone's mind. How will the economy look in 2026? Well, it depends on who you ask. Economist Torsten Slok tells CNBC that the story has changed from worries about tariffs and inflation to now over acceleration.
We still have AI and data center spending in the background, but now we also have a weaker dollar. And most importantly, have the one big beautiful bill where refunds in the spring from households are going to be about 20% higher. Now, normally households get about $3,000 in refunds. So that's about roughly $500-600 increase in payments to households, which should also be helpful. So the bottom line, this story has really changed in the last few months from worry about the economy is about to slow down to now almost a worry about that the economy is about to accelerate.
Ooh, talk about acceleration. He talks so fast, Steve. Wow,
I love those. I love those accents like that, though. I think those are fantastic.
Very, very, nice. Well, here, let's break it down here. So, if the economy over accelerates, is that actually good news for someone who is about to retire, or could it, backfire and create new risk?
There's always risk. When we start to look at everything, we look at headwinds and tailwinds. We look at what was a headwind a few years ago, the political risk. Still there as it shifts. 4 or 5 years ago, inflation was almost non-existent. People weren't even getting a cost of living adjustment almost for their Social Security. Now we talk about inflation. Market risk has always been there. How much risk should I take for the reward that I'm getting? And I think that is the most important thing when we talk about the markets is give me the best return that I can get without taking much risk adjusted. And then I think the one that most people don't talk about a lot is tax rate risk. Because we were told a long time ago, you're going to be in a lower tax bracket in retirement. I find a lot of people are in the same tax bracket that they were in during their working year, or they might be a little lower in the beginning, but when they hit required minimum distribution age, or they lose a spouse, then they go into higher tax brackets. So those are the things that I think we really need to look at is tax rate risk. Why would you be in about the same tax bracket? Well, remember the money they let you take out of the 401k reduced your income. But when you get it back in retirement, it's ordinary income. And if I develop a lifestyle, I don't care if your lifestyle is $5,000 a month, $10,000 a month, or $15,000 a month. Once you get that taken care of, that's what you're going to need. Well, you're going to have to make about the same income to allow that to happen. So that I believe that reducing or eliminating taxes is the best thing you can do for successful retirement. So I look at it and I say, who's at risk? And I say people with too much money in their IRAs and 401ks are at tax rate risk. Well, what's too much money mean? When people hear that the average amount that a couple has in their IRAs and 401ks is around $180,000 to $200,000. So if you've got an extra large between $250,000 and $750,000, depending on your incomes, the number of children that you have, you might spend down those assets during your retirement years, and then once you pass, it's not as big of a problem for our children. But what if you got a double X between $750,000 and $1.5 million? Chances are you're not going to spend all that down. And remember that Secure Act that came along during the pandemic that says we're going to raise the RMD age? It also said now the non-spousal heirs have to take it out over 10 years with some exceptions. And if you've got a triple X, 1.75 million or better, chances are you're going to pass on a tax time bomb to your children because they're going to have to look at this asset and it's got to come out of that tax deferred shell. They don't have to spend it. They just have to take it out and pay the taxes on it. So this thing that they gave us in the 80s, the 401ks and the IRAs, was a great tool to pass to our heirs. The Insecure Act changed that. And now it's not the best tool that we can pass to our kids. So let's look at it. Would Roth conversions make sense for you? Everybody's case is different. Call, ask for the tax analysis. Allow us the opportunity to run Roth conversion scenarios to see if it would make sense for you. Everybody's situation is different. Give us a call now. Ask for the tax analysis and allow myself and my team to assist you in not passing a tax time bomb on to your children.
Certainly want to avoid that. Again, for this tax analysis, 636-230-8824. That's 636-230-8824. And also, speaking of taxes, Steve, you and the team, you have a great event coming up on Thursday, February 19th, and Tuesday, February 24th, specifically focusing on taxes in retirement. Tell me all about it.
Yeah, so it's going to be a lot of things around the big, beautiful bill, things that changed, things that are going to sunset. They're only going to be here for a very short amount of time. We'll look at some current strategies that you can look at. We also can talk about people that have real estate. How could you possibly defer taxes in the area of real estate? What if you're selling a business? Have you thought about the taxes that could happen with that when you do it? We're going to talk about those things. And again, it's at Fleming's in Frontenac. We have limited seating. You must qualify to attend. So give us a call. Ask about the taxes in retirement at Fleming's in Frontenac Plaza.
Again, seating is limited, and you must qualify to attend. And when you give us a call to RSVP to the event, we will let you know how that works. Again, February 19th and the 24th, that is an event focusing on taxes and retirement. That's 636-230-8824. You can get more details on the website, yourmoneymattersstl.com. So when interest rates were going up, we heard that many moved their money into short-term bonds. But as rates are going down, some suggest that you might look at longer-term bonds. So, Steve, where do you look in this environment? I mean, was there another play here?
We look at it, interest rates moving, and the easiest thing for me to help people, interest and bonds are like a teeter-totter. When interest rates rise, bonds values fall. And when interest rates fall, bond values rise. So that's the thing that we have to look at. So we have to look at where we're at in this world, and I'm going to look at it from two different angles. One, on the investment side. Bonds. Shorter duration bonds don't have as much movement. Structured notes. Things that it's a debt investment where we're giving money to a bank, and they're going to pay us off of an index or something of that nature. There's a lot of different structured notes out there, so be careful when you look at them. I also like the income funds where somebody's actually picking. I think Market Guard does a fantastic job with that. So if you're looking on the investment side, those are some of the tools that you could use. So now let's look to a different area. What about the insurance side? A life insurance policy. The taxation within life insurance policies can be very different. You could have tax-deferred growth. You could possibly take out non-taxable income. And it's life insurance is a tax-free death benefit. Then we go to the annuity side of it. Annuities are another insurance product, but I think you got to have the right tool for the right job. Am I looking for a guaranteed income? That's a completely different product and design than all I want's protected growth. I just don't want my portfolio to fall in value if the markets fall. That can only be done within an insurance product. So, lots of different things out there. And if you're not sure where you're at, how much risk you're taking for the reward you're getting, call. Ask us for that risk-reward analysis. Let us look at your portfolio and see where we might be able to protect you or increase the income that you can get from your current portfolio. Give us a call now. Ask for the risk-reward analysis.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group, LLC.
This radio show is intended for information purposes only.